to share with you some strategies that I used in 2001 when I first went full-time as a trader. First, I want to take a look at the range over the close and the range as a percentage of the close. This is an important indicator that we've looked at for a long time. We're currently at about 2%. So the daily range is about 2% of the price, so about 54 points, 27.24 on the S&P, so about 54-point range. And this is as opposed to 2017 where you see this really flat. Some of these are down at 0.3% ranges, the most compressed year I believe that I've ever seen. And so it was a very challenging year. Now we've got a year where we have two spikes that are higher than they've been since 2011. And so we draw this line at 2% and we go back and say, when has this happened on a regular basis? And this is directly related to interest rates. And so interest rates are higher. You're going to get higher average daily ranges between I would say between 1 and 2%. And if you go back and you see that, and you see these spikes and ranges during the financial crisis in 2008, big sell-off, big market volatility, big spike, leading up to that in 2007, 2008, it started building and then it really spiked up here, and you have what 10% daily ranges at this level, so it's very, very, very high. And so then it decreased over time and it went back down to where it was in 2017, and now it's starting to build again. But if you look back even further, let's go back to this was a low volatility period of time as well, 2003 through 2007. And so if you go back though to when I first started, 2001, I was used to these daily ranges, and so that's what made it easier for me in the way I traded was to use these daily ranges to capture big sustainable trends. And so I have strategies that were developed in 1999, 2000, that are right here at this 2% point. We're at this 2% point. It goes it goes down to this level, which is around 1%, and then up to 2%, and even higher than 2%. And so you can see the potential for looking at a strategy that worked back then, and the strategies that I was using when I first started were developed in 99, 2000, and then into 2001 and 2002. And then I struggled as a professional trader when ranges collapsed for the first time. I had not ever traded, and so it was challenging to trade in these narrow ranges way down here. And we've had even lower ranges in 2017. These are still these ranges look low, and this is already at 1% right here. So it would return to the 1% level, which is a nice level to trade at, even at these numbers with our current strategies. But when it gets down to 0.3%, it's difficult, and when it goes up to 10, 4, 5, 10%, it's going to be difficult. But what works well when we're in that daily ranges at 1 and 2%. Now the price level over here was much lower, about half, and so 1% would be maybe 25, 30 point range, and now 1% is 50 and 60 point ranges. And so that also changes the psychology a little bit, because a lot of the same people are trading now that did 20 years ago. And so what worked back then in 2001 when average daily ranges were at 1 and 2%. So I'm going to take a look at that. So here's a strategy using the exact same parameters that I used in 2001, except adding a close at the end of the day instead of holding it overnight. These are the results. So all I did was put in the close at the end of the day, and same stop loss, same exact parameters, not changing anything, and these are the results I get. So this is exciting news to see a strategy from 2000 developed in 1999, 2000. That if you close it out at the end of the day, this is how it works. Now take a look at it from a swing trade version. Now here it is. Here's the exact strategy, keeping trades overnight. Bigger drawdown, still high average trade profit, still a good strategy, but I don't want that kind of a drawdown during this time frame from 2016. Pretty good equity curve, and so nice results from this strategy from 2001. Let's take a look at it through the history, going back to 1997. So as a swing trade strategy, we see how this works going back to 1997. Positive results. Let's look at the equity curve. And so it's a bit choppy. In this time frame, the equity curve has still been up over the years, but this choppiness is not as favorable. But from this time frame, 1017, 2016, it's similar to this time period of higher interest rates, higher daily ranges. This is a little different than that because those daily ranges are actually that 1% becomes a bigger point value, and so the point value hasn't changed, and so you can get bigger moves when you have 1 and 2% moves at twice the price level that we had in the past. And so nice equity curve here, and then it doesn't do as well from this point probably until this point. The volatility in the equity curve is pretty big. But how does this look if we close it out at the end of the day over the history? This is still the swing trade version. So once again, I'm going to put the close at end of day on this original strategy. You can see how it's done throughout history. So here's the equity curve, and it's an improved equity curve. The average trade profit is a little bit lower. The drawdown is a little bit lower. The equity curve is a little straighter. Where did it perform poorly? Well, you see starting in August of 2009, this performed poorly. And then when did interest rates? Interest rates went to zero. The Fed funds rate went to zero. And then in 2015, the interest rates, they started increasing interest rates again in this time period. And so price discovery is difficult when interest rates are low, when money is free, and it's hard to measure true price discovery when money is free. And so you see this time periods when interest rates are not zero. When interest rates are zero, volatile equity curve. And when interest rates are not zero, equity curve is straighter. And so we may have to adjust for this. You might want to go back in time and look at what's worked in the past when interest rates were low and volatility and daily ranges are where they are now. And that's what this strategy does. I'll make this available to you soon, but I wanted to give you that before the weekend.